Is it a viable alternative to a fiat currency? I mean, like, don't trust the fiat currency. So how does it compare to the fiat currency? And so is it an alternative gold kind of thing? Crypto is like a lot of historic currency. There are some that have intrinsic value. It doesn't have intrinsic value, but it has a limited supply. And as long as it's accepted for payments and so on, and has a limited supply, if the demand grows more than the supply grows, it goes up and it serves that purpose. And it's done a heck of a job of programming, stood the test of time. It hasn't been hacked and so on. And so it's a viable alternative. And I think that I think most of the people, and there are different reasons for owning it, but I think most of the people would say, is it a storehold of wealth that's limited in supply and maybe not controlled, and is it a viable alternative to a fiat currency? I mean, like, don't trust the fiat currency. So how does it compare to the fiat currency? And so is it an alternative gold kind of thing? So there's probably an attraction in there, and it has an attraction for me in there. But then there's the question of it, and like how many in the audience, let's ask the question, how many in the audience have some in gold? I'm curious. So that comes in question. So like for me, I have more gold than I have crypto. And so and my basic thing is, rather than make it crypto or rather than make it Bitcoin or the other, I would say diversification is a good thing. We could get into merits of the one versus the other. I don't know where you want to go with this. But in any case, like, let me tell you that either one of those, crypto can go like that, meaning governments could regulate it, outlaw it, or it can be traced and certain other things. So there are a couple of things in that. First of all, I think that it's easier to deal with now. If you didn't, let's step back. Governments don't want alternative currency, okay? Because, and throughout history, we see that they want control over the currencies for all the various things. Since 1700, there have been about 750 currencies. Only 20% of those are still in existence. And all of those have been significantly devalued at one point or another. Okay. So we don't have to pick El Salvador. We can pick the German. We can go through history and pick the most credible. It's the norm, right? And so in any case, what I'm saying is that you don't want, if you're holding a currency, or it's an awfully good way to print money and get the money around, which is going to devalue. Because what is a debt that you're holding? Currency equals a debt. Right. And it means that you receive something and now you have no interest rate on it and they're producing a lot of it. Right. Okay. And so it's the way out. It's ultimately the way out. If you keep it hard, you have a big debt crisis. And if you don't keep it hard, you don't keep it hard. So history's always been the devaluation. So there's a point of that. And they want that, because if you look at history, if they don't have that, but think about that dilemma, just the fact that we're talking about the possibility of that dilemma means that you're going to want something else. And I don't see why one has to be, there's not even enough choices of those types of. So we could take Bitcoin, or you could take gold, or you could take, the advantage of both of those is their money. You easily transfer it. It's very different than real estate, let's say, or equities. Right. Now, equities are in a sense, pretty portable. Pretty portable. Okay. And that's real value. Okay. So it has the same attributes as long as it's going to be real value. And when inflation changes and so on, its value can change along those lines. So equities are a very viable alternative. Right. They're a good alternative. But you think of this category of things that can't be devalued. So the equity bull market that we're having is an extension of that. It's the same thing. Don't differentiate it. What did you think happened? We distribute a lot more credit and a lot more money. There's a flow of funds. There's a mechanics to it. You have a lot more money, you get the money, and then you buy things. An investor who gets the money, when there's an intervention, when the central bank buys, they buy a bond from an investor, and the investor gets cash. And what do? They invest it someplace else. And all through that process, there's the mechanical part of that, and that's what you're getting. So I don't think we even have to split hairs in terms of the one or another, just to make sure you have enough of a diversified portfolio of that and know what kind of an environment we're in. And we're talking now about the money and credit part of that. We also should be talking about the wealth gap part of that, because that affects it. because there has to be a transfer of wealth. So that's going to affect investors, how that transfer taxes and those things are going to take place. And then you have to take a global view of these things, which includes China and other countries. So it's all of those things. That doesn't make any sense to me because of the following reason. Look, I'm no expert in this, but look, there is approximately, let's say gold is an example, and and you make the comparison. There's a certain amount of reflation, certain amount of those kinds of things going up to make a price increase. And then there's a certain market share that gold will have, that Bitcoin will have, and other things might have. If, roughly speaking, there's about, if you take gold, and you take central banks' ownership of gold, I don't think they're going to be owned by, central banks are not going to own Bitcoin for various reasons. I don't believe so. But if you take jewelry out of it and central banks, there's about $5 trillion in gold.
Right.
If you take it for Bitcoin, there's a bit less than $1 trillion. So if you were to say, I'm just going to have a portfolio of those two things, right now about 20% of that portfolio, if you were to say the supply is there and you say, well, what's the right amount of that mix, that's going to be something like, okay, it's 20%. And given the volatility and the total attribute, I don't imagine that the market share is going to be much greater. And so the question is, does that market share rise? Or where do you think the market share is going to go of that? Because you said what I'm saying. Because if it was to go like 10 times as much, then what'll happen is somehow Bitcoin not only will have to be greater than the total amount of money that's held in that kind of non-fiat currency kind of thing, which seems like a stretch too far in terms of that. But it could happen if you have a problem with fiat currency as a percentage of one's own portfolio, that those things rise more, perhaps, but it's very much a stretch. And so when I'm looking at it, I'm saying, let's just, I think, shouldn't we all pay attention to those not fiat currencies, or those things where you can take them from one place to another, and that they're accepted around the world, and that they're not debt and so on. So it's that category that I think is a more interesting conversation than, and do you have a diversified portfolio of those things, and what is good balance? That's the more interesting question. We know we are in the late cycle phase of the cycle, in which there's a lot, and we're just advancing in that. I don't mean much of the differences in that type of thing, and you can tell the increment. All I'm saying, there's a cycle, there are three types of monetary policy, and you can almost judge it. There's first monetary policy, one I call it interest rate policy. You move the interest rates up and down. Then when you hit zero interest rate, you don't have that anymore. The next policy that you have is what I call monetary policy 2, which is also called quantitative easing, where a central bank buys bonds from investor, and then it goes in the hands of investors. The money goes to other investments, and investments go up, and those who have investments do well, and so on, but it doesn't trickle down in the same way.
Right.
Okay, that's monetary policy. Monetary policy 3 is when there needs to be a redistribution of wealth. And the way that works is that only the federal government can determine where the money goes. The federal government gets to determine how much I tax and where I distribute it. And the central bank gets to determine how much there is of it, how much money there is of it. And so when the central bank works together with the central government to direct money to give it to others in that way, which increasingly then bypasses investors to some extent and gets money into the checks that we send money around to be able. And so we're in monetary policy 3, where there's a coordination of monetary and fiscal policy to redistribute wealth, to redistribute money in that way. We're in that kind of monetary policy 3. And then you could judge the size of the deficits and how they're being met. And so the debt problem is not a debt problem like we're not going to pay you up those debts, because at the end of the day, they don't choose to pay them. They don't choose to have a debt crisis. At the end of the day, it's just a question of how long it takes them to print more money to monetize those things. So in 1929 to 32 was when they printed the money, then stocks went up and everything went up. 1929 to 32 took a long time. 2008 took a lot less time. One took 2.5 years. One took, maybe 9 months. This time took like that. And so the next time along those lines, that's what you're going to experience. And then you have that kind of devaluation. So you can see that that's where we are in the cycle. Each of the stimulants has been greater than the one before it. So if you start in, let's say, 1980, and every interest rate increase and every interest rate decrease has brought the interest rates to a lower level. Every peak, every trough in interest rates down till you hit zero. And then when you hit zero, every QE has been larger than the one before.
Is there a way out of the cycle then?
Well, it's like asking, what do you do with the debts? The mechanics of it is, yes, the mechanics of it is have an interest rate that is below the nominal growth rate and below the inflation. So you must have an interest rate that way, because think of it this way. If nominal growth in the economy, in other words, inflation plus real growth, let's say 3 and 3 or 2 and 2, and that's 4 or 5 or 6, and you kept interest rates at 0, then you are going to reduce your debt to GDP, right? Because you reduce debt service. So if you look at the times that it's been most stretched in history, the world wars would have been the most. If you look at the amount of debt creation and the monetization, you would go back into the 30 to 45 period and you would see how that operates. So they hold the interest rate down because what you have is the central bank becomes the owner. Right. And the central bank, when they become the buyer, they can tolerate whatever the central bank wants. If the free market goes away and the central bank wants it, that they could hold it. And they hold that interest rate while inflation rate rises. And then what you do is you see your loss of purchasing power, such as we're seeing if you hold it in debt. And that's one of the ways you deal with debt.